Ever wonder how a great idea actually becomes a real company? From the coffee shop on your corner to a tech giant that literally changes the world, they all have one thing in common. They needed money to get started. In this explainer, we're going to pull back the curtain on the financial marketplace. This is the engine that turns those bright ideas into booming businesses.
So, let's get right to it. How does a company with a brilliant concept, but, totally empty pockets, get the financial capital it needs to grow, to hire, and to build? Where does that money actually come from? Well, the answer lies in connecting two very different groups of people.
See, on one side, you've got entrepreneurs and companies with these world-changing ideas. They're demanding capital. And on the other side, you have ordinary households, people like you and me, with savings that are just sitting there looking for a way to grow. They're the ones supplying the capital. But there's this huge gap between them, right? You can't just call up Apple and offer to invest your savings. That's where the financial market comes in. It's the bridge that connects them.
So first up, let's look at this whole thing from the company's point of view, what we call the demand side. Think of these as the shoppers in the marketplace, looking for the financial fuel they need to get going and to expand. Now, when a company needs cash, it really boils down to two main options. It can borrow the money, or it can sell off a little piece of ownership in the company itself. Let's break those two down. The first option is borrowing, and they often do this by issuing something called a bond. A bond is basically just a formal IOU. When you buy a company's bond, you're lending them your money. In return, they promise to pay you regular interest, and then, down the road, they give you your original loan back. In this deal, you're the lender. Okay, the second option is selling ownership through stock. And a share of stock is, well, it's exactly what it sounds like, a tiny slice of the company. When you buy a share, you're not just a lender anymore. You actually become a part owner, a shareholder. You now own a little piece of that business, and you get to share in its potential profits and its losses.
Okay, so that's how companies get money. Now let's flip this around and look at the other side of the marketplace. This is where you and your savings come into play, supplying the very capital that all those businesses need to thrive.
For most of us, supplying financial capital doesn't mean we're in a boardroom negotiating with a CEO. Nope, it happens through things we're way more familiar with. You're participating when you put money in a bank account, which the bank then lends out, or you can get more direct by buying those bonds we just talked about, or by purchasing shares of stock. And a really popular way to do it is through something called a mutual fund, which we'll get to in just a sec. Now, here's the thing. Buying stock in just one company can be a total roller coaster. I mean, it could do great, or it could totally flop. That's why you always hear that old saying, don't put all your eggs in one basket. This strategy, spreading out your investment to lower your risk, has a name. It's called diversification. And this brings us to one of the most popular ways to diversify, the mutual fund. Instead of you having to go out and pick dozens of different stocks, a mutual fund does all the heavy lifting for you. It pools money from lots of investors and then buys a whole range of stocks or bonds. So by owning just a piece of the fund, you instantly own a tiny piece of many, many different companies. It's diversification made easy.
Okay, this all leads us to the fundamental rule of all investing. It's the core trade-off that every single investor has to deal with, the relationship between risk and return. Every financial choice you make is a balancing act between these two. So if you look at history, stocks have given a much, much higher average return than safer options like, say, a savings account. And that brings up a really important question, right? If that's true, why doesn't everyone just pour all their money into stocks? And I mean, the difference is huge. The average annual return from the stock market, we're showing the S&P 500 here, which is just a big basket of 500 large U.S. companies, has historically just dwarfed what you'd get from a basic savings account. It's a massive gap in potential growth. But, and this is a big but, that potential comes with a catch. The answer to our question, in one word, is risk. A savings account gives you a super low return because it has almost zero risk. Your money is safe. Stocks, on the other hand, offer that high potential return because they come with high risk. The market is volatile. Prices can go down just as fast as they go up. That higher potential reward is your compensation for taking on a whole lot more uncertainty. So, with this constant balancing act between risk and reward, how can a regular person even hope to build wealth? It might seem like you need to be some kind of expert stock-picking genius, but the truth is, the most reliable path is actually way, way simpler.
You see, it is incredibly hard to beat the market because of something called the random walk theory. The basic idea is that all the public info about a company is already factored into its stock price. So what moves it is new, unpredictable information. And that means on any given day, the price is pretty much just as likely to go up as it is to go down. Not even the pros can consistently guess which way it's going to go. So that whole dream of getting rich quick by finding the next big stock, it's mostly just that, a dream. But that doesn't mean you're out of luck. There is a reliable, if kind of boring, path to building wealth. It just relies on two things that we can actually control: time and consistency. Let me show you a really powerful example. Imagine, at age 25, you save just $3,000. That's it. Not every year, just one time. And you invest it in a diversified mix of stocks. And then you do the hardest part. You wait. You don't touch it. You just let it sit there for your entire working career, for 40 years. After those 40 years, assuming a historical average real return of about 7%, that single $3,000 investment would have grown to roughly $45,000. That is the incredible, mind-blowing power of compound interest. It's when your earnings start making their own money, and the growth just starts to snowball over time. And this example, it really gets to the heart of it all. Building wealth, for most of us, isn't about a lucky stock pick or some genius move. It's about starting early, being consistent, and just letting that slow, steady force of compounding work its magic for you over a lifetime. Which leaves us with one last, really crucial question. It's not about trying to time the market or find the next big thing. Based on everything we've just seen, what's the single best financial decision you can make for your future starting today?